Hello and welcome to the lecture for Chapter 1. I'll always start each lecture with a slide or two that covers the learning objectives for that chapter. That's how we'll start things. So this chapter gives a broad introduction to accounting, the role that accounting plays in society, a little bit about what kind of entities use accounting to report how they've done. I'll talk about the accounting equation, which is a fundamental concept. Talk about the effect of business events on that accounting equation. We'll talk about how to interpret the accounting equation and how to classify transactions. And then I'll give a brief overview of financial statements. So income statement, statement of changes in stockholders' equity, the balance sheet, and the statement of cash flows. So accounting is a large field that's comprised of different subfields that I want you to be familiar with. What we'll focus on in the first half of this class, so the first 3 weeks or so, is financial accounting, kind of the light red circle there. Financial accounting deals with reporting to outsiders, so telling lenders how a company is doing, telling owners who are technically outsiders how the company is doing. So that's the focus of financial accounting. There are rules associated with financial accounting called generally accepted accounting principles. Sometimes that's referred to as GAAP, GAAP. That's so that there's consistency over time about how a company reports their earnings, and there's consistency between companies. Everybody's following the same set of rules. Cost accounting is the field of accounting that's concerned with determining how much an object that we create, a product, cost to make, or how much a service we provide costs to create. So as an example, my old company, we used to be concerned with what the cost of a playground that we delivered was, comprised of lots of different materials. If you worked in a hospital, you'd be concerned with what the cost of setting a broken leg or doing an MRI, those sorts of things. So companies need to know that so that they know that they're charging the right amount. They're not charging less than what it costs them to provide it. Managerial accounting, which we'll cover in the second half of this class, deals with accounting that takes place within the company. And the goal there is to provide information with which we can make good decisions in the company. So oftentimes, we're looking at the same results, but just at a greater level of detail and maybe in a different format than we do for financial accounting. So a little bit about reporting entities. So a reporting entity is any organization for which you want to keep financial records and be able to determine how the entity did. So reporting entities can be for-profit corporations, they could be nonprofit entities, it could be segments of organizations, it could be branches of government. All of those kinds of organizations keep financial records. Those financial records are kept so that stakeholders can get the information they need to make the best decisions. One would be owners or shareholders. Those are people that own a portion of, say, a corporation. They want to know how the company is doing so that they can determine, should I leave my investment there? Should I pull my investment, or should I add to it? Creditors, those are people like banks and credit card companies and anybody that lends the company money or provides something to them on credit. So those kinds of people are worried about one thing and one thing only. Are they going to get paid back? So they're very concerned about what the cash flow of the company is going to be in the future. Are they going to generate enough money to be able to pay this debt back? That's the question they want to ask. So employees, and this in particular, employees that are unionized, want to understand how a company's doing so that they know what they can reasonably ask for in terms of raises or improved benefits. They don't want to ask for too much and kind of kill the golden goose, right? Cause the company to fail, and then the company can't provide jobs or anything for them, but they want to know what they can do reasonably. Then suppliers, I would almost put them in the category of creditors. Suppliers will often provide products, supplies, services to a company in return for the promise to be paid later. And again, they're concerned about that. So the accounting equation, and as I mentioned, this is really fundamental. The accounting equation is assets equal liabilities plus stockholders' equity. So a little bit about what those words mean. Assets are what the company owns. They own They might own buildings and land. They might own machinery, trucks, computers, furniture, machinery, forklifts. All of those kinds of things are things the company owns. We'll talk about those more later in this course and kind of get into more detail, but just assets are everything the company owns. That includes financial assets like money in the bank, that sort of thing. Liabilities, that's another word for debts. Those are all of the debts that the company owes to other people. They might owe money to their suppliers. They might owe money to their employees for paychecks that haven't been issued yet. They might owe money to the government for taxes. They might owe money to different banks and other kinds of lenders. And then what's left over is the stockholders' equity. That's the interest that the owners of the company have in the company's net assets. So think of those two sides of the equal sign as being what the company owns and the claims on those assets. So who's going to want to put claims on the assets to get paid? So that equation is always going to be in balance. After every single transaction, either both sides are going to go up the same amount or both sides are going to go down by the same amount. So every transaction results in that equation staying balanced. So briefly, the four financial statements that tell the full picture of how a company is doing include the balance sheet. That's basically the accounting equation in the form of a financial statement. So it's what the company owns and the claims on those assets. This is important. It's as of a specific time. So on December 31st, standing at that moment, the end of that day, what did the company own? What did it owe other people? And what was the owner's interest in the company? The income statement, that says whether or not the company was profitable. A lot of times people will call it a P&L or a profit and loss statement. That is revenue minus expenses for a specific period of time. It could be for the year ended December 31st or the month ended December 31st, but it's for a period of time. What revenue did we earn? We earned revenue by providing products and services to customers. And what were the expenses that were incurred in the effort to earn that revenue? Statement of changes in equity, that is just a reconciliation of the owner's interest in the company. What was it at the beginning? What influenced it over the course of the year? So it'll be increased by net income, decreased by losses, decreased by the owners pulling money out of the business, and what's the balance at the end of the year. Lastly, the statement of cash flow shows where money came from and where money went to. And I'll go over all of these and show you examples later in this lecture. So a little bit about elements of financial statements, so words that you'll see on financial statements. We already talked about assets, liabilities, and equity. So to dig a little bit deeper into equity, there are components within each of these categories. As an example, with equity, we have contributed capital. That's money that the owners of the company put in to the company in return for shares of ownership. We have retained earnings. Those are the profits for the life to date of the company that have been retained in the company, not paid out to the owners. Earnings that are paid out to the owners are called distributions or dividends. Revenue, jumping to the other side there, revenue is again what we earn when we provide products or services to customers. Expenses are the costs we incur in the effort to earn that revenue. Gains and losses are what happens when we sell an asset. So that isn't something that we're normally we do in the course of business, but we might sell a truck, we might sell a building or a piece of machinery, and we might sell it for more than its cost and have a gain, or less and have a loss. Net income or profit is the difference between revenue and expenses. So the equation is revenue minus expenses equals net income. So there are four types of transactions that I want to cover, and all transactions will fall into one of these four types. So the first is an asset source transaction. That's where the total assets increase and the total claims on those assets increase. So both sides of the equation go up. An example of that is borrowing money from a bank to buy a truck. After that transaction, I have more liabilities. I owe the bank money I didn't owe before, and I have a truck I didn't have before. The next type of transaction is an asset exchange transaction. That's where one asset goes up and another asset goes down. So both sides of the equation stay unchanged. An example of that would be taking cash out of the bank to buy office furniture. After that transaction, I have less cash and I have more office furniture. Next type is an asset use transaction. That's where assets go down and liabilities go down. An example there would be taking some cash and paying off maybe the loan that we used in that first type of transaction. So in that case, after that transaction, I have less cash in my bank. Cash has flowed out of the business and I owe less money. So both sides have gone down. And the last type is a claim exchange transaction. That's where one type of claim goes up and another type of claim goes down. An example there would be incurring debt for expenses. Here's an example of 7 transactions, and we can see here how we've expanded that equation. You can see it's assets equal liabilities plus stockholders' equity, but then beneath that we've expanded that to have, now we've got 2 categories of assets, cash and land. Under liabilities, we just have 1, notes payable, and then stockholders' equity, we've got common stock, which is that contributed capital I talked about, and retained earnings. You can see here retained earnings is impacted by revenue. That makes it go up. Expenses make it go down, and dividends make it go down. So the first transaction there, you can see RCS issued common stock acquiring 120,000 cash from its owners. That's contributed capital. So cash goes up, common stock goes up. Both sides of the equation increase. That's an asset source transaction. Next, we borrowed 400,000 in cash. That's another asset source transaction. In this case, cash goes up by 400,000 and so does notes payable. The next transaction, we paid 500,000 cash to purchase land. That's an asset exchange transaction. Cash is going down and land is going up, so both sides of the equal sign stay unchanged. And then you can see we have a revenue transaction, an expense transaction, and then we paid dividends out to our shareholders. So the last one there is not really a transaction, it's just information. So the economic status of the organization didn't change. So that's why NA is shown across the bottom there. This would be a good time if you're watching this at home to stop and do exercise 1.5 and 1.6 in the working papers. So a little bit more about the financial statements. So the income statement, as I mentioned earlier, that's revenues minus expenses equal net income if it's a positive number, and net loss if it's a negative number. And it's for a specific period of time. So it's a month, a quarter, or a year usually. And the important part is we want to match expenses with their related revenue. If I incur some expenses in December that are actually associated with a job I'm doing in January, I'm going to want to wait and match those expenses in January, not recognize them in December. So matching the expenses with the revenues in the right period is key to being able to tell a story that is as close to the truth of what happened as possible. Also keep in mind that net income is not the same as positive cash flow. You can have positive net income and still go bankrupt. The reason for that is we recognize revenue when we earn the money, not when we we recognize revenue when we provide products to customers, not when we get paid from the customer. So here's an example of a very simple income statement. Revenue minus operating expenses equals net income. Notice the header there. All of the financial statements are going to have 3 lines on the header. The name of the company, what it is we're looking at, in this case income statement, and then the next language is really important. For the year ended December 31st, year 2. So it tells us what length of time this covers and when it ended. The next statement we'll do, and we do them in this sequence, we do the income statement first because we need information from the income statement to be able to do the statement of changes in stockholders' equity. So as I mentioned earlier, that reconciles the beginning and ending balance of this category. Again, it's for a period. What happened during the month, during the quarter, or during the year. It's increased by issuing shares of stock and by net income. It's decreased by distributions to stockholders, which are called dividends, or net losses. So you can see here there are two parts to it. One part deals with contributed capital, so beginning common stock plus we issued stock gives us the ending amount. And the second section deals with retained earnings. As I mentioned, retained earnings, we have the beginning balance there. It's increased by net income. It's decreased by dividends, what we don't retain in the company. And that gives us an ending retained earnings figure and total stockholders' equity. The next statement we do, and again, we needed to do the income statement first so that I could get that $54,000 figure to use for the stockholders' equity statement. The next one is the balance sheet. And the balance sheet kind of tells us, if the income statement tells us did we make money or not, were we profitable, the balance sheet tells us how healthy the business is. And it mirrors the accounting equation. It's based on historical cost, not appraisals or rumors about values or things like that. We put an asset on there as to what we paid for it. It's recorded as of a point in time, usually the last day of the fiscal period. We list assets in order of liquidity, so what's closest to being able to be spent. Cash is the first item. The end of one year becomes the beginning of the next year, and I mentioned it's used to determine the financial health of a company. So in this case here, I'm showing the second year of accounting events for that fictional company we had. And you can see the beginning balance there, kind of in the middle of this slide, is the same as the ending balance from the previous year. And then we have the transactions for the year with new ending balances. So now we can do a comparative balance sheet. We can show what was the situation for this company, what was their health at the end of this year compared to the end of last year. Did they get healthier or less healthy? So you can see here we show assets of cash and land. For total assets, we have liabilities, just one, that note payable, and then we have our stockholders' equity. And you can see here total assets in year 2, $328,000 equals total liabilities and stockholders' equity of $328,000. So it is in balance. Again, that's the equation being in balance. The last statement is the statement of cash flows, which is really important. It tells where money is coming from, where cash specifically is coming from, and where cash is going to. It's also reported for a period of time, a month, a quarter, or a year, and it's grouped in 3 categories: operating activities, investing activities, and financing activities. So operating activities are money coming in from customers and payments going out to suppliers and to employees and all of that for generating the revenue. That's a really important figure for a company. In the long run, that number has to be positive or the company isn't going to make it. Cash flows from investing activities, that's either buying or selling long-term assets. And then cash flows from financing activities is cash flows related to borrowing money, issuing stock, or paying back money that we owe, or paying dividends. So dealing with banks and long-term liabilities and dealing with our owners. So that produces a statement that shows as follows. What kind of cash was produced from operating activities? In this company, it was $54,000. What kind of cash came from investing activities? Well, they sold some land, $200,000. And then what kind of cash was derived from financing activities? Well, it was a net outflow because we paid off that note payable. So we had negative $277. That will then reconcile the difference between our beginning and ending cash balance. So again, the important part of this is to look for companies that have a positive operating cash flow, because eventually you'll run out of assets to sell and you'll run out of people that will either invest money or loan money to you. So this last slide just shows a little bit about how we can take that transaction grid where we use to capture transactions, and we can expand that to include the income statement and the statement of cash flows. And as I mentioned earlier, the accounting equation is basically the balance sheet. So we can derive our financial statements from this very grid. So that's the end of the lecture for chapter 2, or chapter 1 rather, I'm sorry. I look forward to talking to you with chapter 2. Bye-bye.